Hello and welcome back to Investors Heaven. I'm continuing the series that I started some time ago, in which I'm talking about known investors' portfolios. And today we will be examining Warren Buffett, one of the behemoths of the investing world, right? And we're gonna take a look at his portfolio and talk about his largest 10 holdings, because he does have quite a few. And we can take a closer look at the portfolio here. You can see the ticker symbols. And you will notice that Warren Buffett is very, very big on Apple. And then second next is Bank of America. But he holds like 3 times as much in terms of a percentage of Apple than he does with Bank of America. And he bought that kind of recently. He used to have almost no Apple at some point, and he kept on buying, and it looks like he's doing very, very well. He actually has a 5.6% of Apple, which is crazy in total. And then he does have Bank of America, American Express, Coca-Cola, Kraft Heinz, Usborne Corp, Moody's, Verizon. A lot of known companies, household name, and banks is what Warren Buffett likes to have. And let's take a look at his portfolio. I have created a watch list here in which we can use to examine his portfolio in a little bit more detail and see what Warren Buffett likes, and maybe we can learn something from him. I mean, we should. So Apple is the first one and the top holding in his portfolio. Why does he like Apple so much? You can see here Apple is obviously giving a little bit of paying out a little bit of dividend, but it's almost nothing, and has billions of shares outstanding. And regardless of that, the share count keeps going down. Now that may have to do with the split as well, because actually Apple did split at some point. So this is something that you want to examine when you're taking a look at the history. But generally speaking, seeing the shares outstanding go down, you can't say it's a negative thing. So it may not be necessarily a positive one, but it's definitely not a negative thing. And so Apple has been doing pretty awesome, like gaining 32% in a year. And yeah, it's been a little bit down this past few weeks, but the whole market, I guess, it's kind of not performing as well as before. And currently, Apple is obviously making a lot of cash flow, like many billions of cash flow every quarter, really. And every year, it's like 70, 80 billion. I think the latest one was like 90 or so. And its valuation is very lucrative. The valuation of Apple is about 2.8 plus 2.8 plus billion, actually. It's almost a trillion. It's almost approaching $3 trillion right now, which is absolutely insane. And so regardless of that, the PE of the company is 31 almost, and going down to almost 30.4 in the next 12 months. So the company is relatively expensive. However, it's a tech company and a giant, and you are probably going to be paying a little bit of a multiple if you buy it right now. And so it may be a little bit expensive. Now, obviously, I love Apple. I mean, Apple is a great company to invest in right now. I mean, it's making tons of money, and its balance sheet is stellar. I would want it to go down a little bit so that I can buy it at a better PE. However, if you are not into Apple, I mean, I think it's generally speaking a very, very good idea to get some shares of Apple. I myself have bought Apple quite a few times actually and sold again. Currently, I don't own any Apple, but I'm waiting on an opportunity really. I'm waiting for the market to drop it a little bit if that happens, so that I can get it at a little bit of a discount if possible. Otherwise, I'm just gonna wait for maybe even better opportunities. There's no shame in that. So next up, the second largest holding is Bank of America for Warren Buffett. And Bank of America is interesting because the forward PE is 15.7, which points to a very, very low PE compared to to the company's share price. I mean, that's what the PE tells you in terms of its earnings and share price. And so this points to an undervalued company, because a multiple of 15 you can pay all day for a company that makes good cash flow. And generally speaking, and in this video, my point is not to examine the cash flow of every company and dive into details. I'm doing that in separate videos. But generally speaking, when you're looking at a low PE, the price to cash flow ratio, which is what we examine a lot when we're taking decisions about whether a company is undervalued or not, is going to be fairly close to that value most of the times. There can be some, some accounting tricks that can bring the P lower than the P ratio lower than the price to cash flow ratio, but generally speaking, they should be relatively similar. So we're going off of P here just because it's easier to examine. And yeah, Bank of America also pays quite a nice dividend yield here, which is also very interesting. And again, it's boasting a relatively low P, which seems to be raising a little bit here, but still, it's been growing better and better. The company, it looks like, and with the current stock price at 49, it may be an interesting opportunity to grab even here. It used to have a high of 49. Sorry, that's the daily one I'm looking at. My bad. So let me take a look at the let's take a look at the 5-year one. Oh yeah, so right now it's actually at all-time highs. So that's interesting. With an all-time highs price, still the company's forward P is 15.7. That's very interesting. It may be a very interesting addition to a portfolio. So I could see myself actually entering Bank of America even right now. Obviously, I would want to examine the cash flow and all that, like take a look at the balance sheet and everything. But on the at first glance, it looks very interesting. All right. So next up, and we can also go back to take a look at the percentages. Bank of America is the second one, and then is the third one, American Express, what Warren Buffett is holding. So, American Express. So American Express here. Again, likewise, Warren Buffett seems to like companies that are undervalued or close to it, which makes sense, right? This boasts a current P of 18.2 and seems to be rising slightly in the next 12 months. But still, I mean, it's a relatively low PE. And it's a bank again, and it is paying a little bit of a dividend, likewise. And the gains last year, 42%. That's pretty awesome, right? A lot of a lot of nice gains from the stock for Warren Buffett here, and I like to see that the EPS is rising here, and is expected to rise even more, very nicely here. So that's some good growth. So yeah, I like to see the American Express here. I like what I'm seeing, and I think it's a potentially interesting addition as well to the portfolio. I mean, all these companies that we have examined are very interesting, really. The next up, I believe, was Coca-Cola, and then Kraft Heinz. So let's take a look at Coca-Cola. Coca-Cola here. Now, Coca-Cola is having a 25 forward P, and I have examined Coca-Cola myself. I haven't made a video about it yet. I was thinking of making one. I thought it's stagnating a little bit in terms of its growth, which you would expect. I mean, it's a massive company. I mean, some companies that are giants, it gets tougher to actually grow. Plus, they tend to pay dividend, as Coca-Cola does here, and that's a pretty hefty dividend over here. And so I'm pretty sure that payout ratio is gonna be relatively high here. And so this kind of company, yeah, you can hold it and gain some good money over the years from its appreciation in price and dividends, which is very important. But I think it's gonna be, generally speaking, not too much growth for the stock price. I mean, I think you will be gaining most of your money from dividends, from the dividend yield, really, which is fine. I mean, getting some income from dividends is always nice. So I could see, adding some stake for me on Coca-Cola, maybe at some point, because I do like value investing. I do like value companies, and I do like the fact that the next 12-month PE is projected to be 25, and right now it's 30. So that's a significant decrease of the PE, and I like to see that a lot. And yeah, this is a company that again I could definitely see myself adding some. Maybe at a better price. I'd like to see it a little bit lower. And the thing is, these kinds of companies, you hear me saying that I want to see them a little bit lower. They're not gonna go too low, but I still want to get them if they're going to 44, 54, or 50. Maybe that happens. That's very likely to happen. It has happened multiple times over here. You notice some drops. So I'd like to get it in a little bit of a drop, and I'm pretty sure it's gonna come up again, but I like to have a little bit of a leeway. Like, why be in a rush? I don't see the reason. These kinds of companies tend to trade in a range for a long time. As you see here, it's 50 to 60. These are very, very large companies with very large market caps and insane amounts of outstanding shares. So they don't move that much in terms of value, in terms of stock price. So you see that it's like 0.4, 1%, 2%, maybe 3 in some days, but they're not going to be moving in like 10%, 15% every day. That's not going to happen. It's going to be a one-off when it happens, and for some important reason. So this is why you could wait for these kinds of stocks to go down a little bit before adding them to your portfolio. And it's nice to add them for the long run, for sure. I would definitely add Coca-Cola. Kraft Heinz, a company that I actually do own. And Kraft Heinz hasn't been performing well. And yeah, I have seen that in my portfolio as well. However, I have been getting some very nice dividends. So Kraft Heinz has been paying me well. And I have made a big percentage of what the company has been down in terms of what it has been down. And I still believe that this company has a lot of room to sharply rise in terms of its stock price at some point because it's very undervalued. So right now the forward PE is at 15, and it is 20 today, and it's projected to be at 15, and that's a very, very nice PE. I mean, it's very, very cheap. And also Kraft Heinz is a household name, a lot of known products, and yeah, it has been lagging in growth and everything, so it did make sense that it went down. You would expect that, but I did purchase it, I did buy it, it was like 3 years ago or so. It's been a while, and it has been paying me again pretty well in terms of dividend yield, because I'm not gonna sell just because the company's stock price goes down. That's not gonna happen. It has to be an important reason for me to sell companies that I own, that I have invested for the long run. And even though I have lost money here, like in paper money, sort of, I haven't sold. I'm gaining a lot of income from dividends, and it's substantial because that percentage is, as you can understand, a pretty good dividend yield. And yeah, in that period of time, there has been a little bit of a drop or a cut in dividends, which also led to the price of the stock going lower. Yet it's still at 4.24%. So I mean, that's pretty great, and I'm getting a good payout here. So I'm not worried. I think it's gonna eventually go up again. So I think this is actually a good addition for a portfolio as well. Let's take a look at the next one, which is Usborne Corp and then Moody's. So Usborne Corp here, let me find it. Usborne Corp here. All right. So Usborne Corp, what's up with this one? An awesome dividend yield and a low forward PE and a current PE. Although it's projected to grow a little bit. That's not great, but still, it's very low. Now, you will notice again the same thing. It's a bank, and it's a bank that has a low PE, and this is great. In a bank that gives out good dividend yields. And another company that you can potentially add to your portfolio. For me, I'm not a huge fan of adding too many banks in my portfolio, and I like to have like a couple maybe. But I'm not a massive fan, just because I think there's a little bit of a risk in terms of leverage, and if the world goes down for some reason, if the markets crumble, banks are gonna be affected massively, obviously. And so I'm a little bit scared of holding too many banks, but still I do appreciate the nice dividend yield of a couple of those and the potential growth. Although these banks tend to be not the trendy material that some investors would enjoy adding to their portfolios. But for me, I do like. I'm an investor that likes to take advantage of the trends, yes, but also invest for the long run on steady stocks and steady companies. And so I do appreciate having these kinds of companies that will pay me out some dividends, and I'll just have them there in my portfolio waiting to get paid in dividends every quarter. So that's something nice to have, and also enjoy some appreciation over the years. Plus, because these companies have a low forward PE, there's not much risk of losing value in terms of their intrinsic value, because they are already low, it's already low based on what the companies are making. I mean, it's a 15 multiple for earnings. That's pretty good. So I like to see that it's relatively cheap. Next up was Moody's, I believe. So Moody's here. Moody's is a company that's a little bit higher in terms of PE over here, paying a very low dividend here, which is still pretty nice. But you can understand that the P is higher because the company has been reaping has been reaping the markets. Like the stock price has been growing higher and higher and higher, and so at some point it exceeds the actual value of the company in terms of its earnings, and it becomes a higher multiple of 32 right now, projected to grow to lessen a little bit later in the next 12 months. And so relatively okay growth here in sales and EPS. EPS seems to be growing nicely, which is nice, pointing to a lower PE eventually. And so yeah, this is another company that looks interesting, and for purchasing. And again, it's a financials company, by the way. Capital markets is what Warren Buffett enjoys. I forgot to mention that. But this is a company that, yes, I would potentially also see myself getting into. Again, I don't like holding too many financial companies that have to do with financials, the financial sector and the banks. Yes, I do like to hold some, but not overdo it. In this case, I wouldn't buy Moody's now because I think it's expensive for what I would want to get it. But if it goes below 300, I would think about it for sure. Maybe in these levels, like 270, would be a nice entry point. May happen at some point. Who knows? So what's after Moody's in his portfolio? Let me find it here. So it's Verizon and BYD. Like next up. So Verizon. Let's take a look at Verizon. Communications companies. Verizon. I did used to own. I think I still own it actually. T-Mobile. I haven't owned Verizon. Maybe I have in some of my ETFs actually, because some ETFs do have Verizon. So Verizon, a rich dividend yield company right now. 4.76 is a fantastic dividend if it can be held over the years. And for this reason, I could definitely see myself getting some. And I like the fact that it's lower than all-time highs. You won't see it much lower. So these levels were awesome over here, and they may be visited again. But even here, I mean, I think it's a potentially interesting addition to portfolio over here. Forward P at 10. Wow, that's very cheap. That's amazing. All right, so yeah, this one looks like a very interesting entry here. Even here, it looks like a very interesting entry. I'm actually surprised I didn't know this company's PE. It looks like a very interesting company to examine in a separate video. It looks like it may be very undervalued. Sometimes these companies investors don't like so much because of dividend yields extracting too much cash flow from the company, not allowing it to grow that much. But again, if you want to get some income, I mean, a 4.76% of dividends is pretty nice. Now, so you have to be a little bit careful about income because it's taxed differently, so it may not make sense depending on where you live. But still, I mean, it's an interesting opportunity for people who like to have some income every quarter, worth examining maybe. But this is why these kinds of companies tend to trade in a range, which is good and bad because they are less volatile. But you're not gonna be killing it with their stock price. That's what happens pretty much. Boyd Gaming, which is a hotels, restaurants, and leisure industry company. Again, with a very low forward PE here, even lower than the current low PE. So that's nice to see. And it's even more interesting that the company's stock price is actually ripping. It's really high, and even though it's that high, the PE is that low. And imagine what was the PE here. More than likely it was probably less than 10 or so. Even potentially much less than 10 could have been. I don't know what they were making here and what they are making here because I haven't examined the financials, but that's very interesting to take a look at potentially. No dividends, but the company stock price has been growing tremendously here, as you can tell, and very nice growth over here, fiscal year 2021. The projections appear to be lower. So yeah, very interesting one, and maybe worth examining in detail for addition to a portfolio. Maybe again if it goes lower a little bit. All the companies are ripping it these days. I mean, all of them, the stock prices are so high. It would be nice to have a little bit of a correction at some point to buy some. All right, Bank of New York, Usborne Corp is the next one. Bank of New York, and who would have thunk it? Another bank. So capital markets industry, of course, Bank of New York, and 2.12 dividend yield with a forward PE of 15. Again, a very low PE, and a company that's been ripping the markets. Like, look at that. insane growth of its stock price over here, doubling, or more than doubling in what, like not even a year. That's amazing. And yeah, I mean that's some insane growth over here. Company has been killing it. And so this is a company that has also, again, a low PE, seems to be growing nicely and projected to be lower, and has some interesting percentage of Warren Buffett's portfolio. It's the 10th one actually, the Bank of America Mellon Corp, with 1.3% of his total portfolio, which is definitely not negligible because it's it's in the many millions here. All right. So this is what I wanted to examine in this video, Warren Buffett's portfolio in detail, talk about it, discuss it, and get some ideas. And this already gives me some ideas of potentially taking a look at some of these companies and stocks in separate videos. If you do want me to take a look at a specific one, let me know in the comments below. And if you did enjoy the video, please subscribe and like it, because that helps the channel grow. And I will see you in the next video. Bye bye.